Under the coronavirus, many stocks have been hit extremely hard, and you're probably wondering what to do. But amidst all the panic, I've compiled a list of 4 businesses that could potentially be one of the best investments of your life. Hey everyone, in this video, I'm sharing with you what I think are extremely undervalued stocks right now in 2020 that have been beaten down double-digit percentages. However, in my opinion, these are also much less risky bets than many of the other stocks you've been recently hearing in the news, such as Boeing or Carnival, for example, while still getting great returns on your investments. However, if you want to see a video of me analyzing those riskier companies, do let me know down below in the comments. Make sure you watch all the way. These stocks aren't organized in any way, so the last one might be just as good as the first. So obviously, due to the ongoing global shutdown, many companies are very likely going to go bankrupt. And obviously, you can get huge returns on them if you happen to get lucky. However, as a firm believer in reducing risk, I believe that you can avoid these huge bets and still have just as good returns compared to the risky ones. Before we begin, I'm not a financial advisor and everything is just my opinion. Additionally, I'm going to leave the in-depth research to you and what you find about the company yourself. Out of these 4, if there's one stock that really clicks with you, make sure you do your own research first before investing. So let's get started. So number 4 is going to be Air Canada, ticker symbol AC, Canada's largest airline. And while everyone is looking at Delta or Southwest, Air Canada has really flown under the radar. And the reason I chose Air Canada is that it actually has completely crushed the market, rising 60 times in value in the past 8 years. But like every other airline, it is losing a lot of money, over $15 million per day. However, Air Canada actually has a decent and solid balance sheet compared to its peers, having around $4.5 billion USD in cash, allowing Air Canada to survive for months until everything has cooled down. Another thing to note is that the competition in Canada is actually significantly less than of the US. While 80% of the US market is dominated by 4 companies, Air Canada's competition really only consists of WestJet. But despite all these good factors, Air Canada has dropped over 60% in the past few weeks, and honestly, I just don't think Canada's largest airline will go under. So, number 3 is going to be Raytheon Technologies, ticker symbol RTX. Now, very recently, United Technologies, an aerospace company, merged with Raytheon, a space and defense company. And the reason why this is low risk is because while the newly formed Raytheon does depend on commercial airplanes, which is why its stock has dropped just under 60%, it actually heavily depends on defense as well for revenue. And honestly, under all the events going right now, I don't see the US government suddenly cutting all of its defense budget, especially if Trump is going to get reelected. And because defense isn't changing, it acts as an anchor to Raytheon, so they still have revenue. Even if the commercial side of their business fails, it will eventually recover, with little risk of them going bankrupt in the meantime. And with high earnings with a PE ratio of under 10, I think this could be a very good buy for long-term growth. Next up on the list is going to be Live Nation, the world's largest live event promoter and venue operator. They also own Ticketmaster, a dominant name in the ticketing space. It's very possible that many of your favorite pop stars and singers on tours or concerts actually use Live Nation, as well as the major sporting events, such as Taylor Swift, Shakira, the NBA, and NFL. And while they are probably the most risky out of anyone on the list, if you want larger gains, this is the one for you. Falling around 50% in share price, they've been cut in half due to lack of concerts. However though, Live Nation's balance sheet is slightly scary, having $3.3 billion in debt and just $2.4 billion in cash. But according to their president, they are also enacting cost reduction plans, and they could safely last around 6 months with the plan they're running now, with many concerts scheduled for after June. And according to the recent news, they're also trying to cut $500 million in costs for 2020 to get them through. But if you want to know more, as I suggest, go check out the investor page on their website to know more information. Additionally, it also doesn't hurt to know that this stock was actually directly endorsed by millionaire investor Paybri in an interview, saying that he loves Live Nation as a business and that if there is going to be a long-term compounder, it is Live Nation. Lastly, number 1 on the list is going to be Disney, probably the safest stock on the list if that's what you're after, falling around 30% as of today. Additional to the parks, they are also hugely diversified and own ESPN and National Geographic in addition to their cruises. But while it's been more stable than the other stocks on the list, Disney still has been cut a huge number and is one of those very stable blue chip companies that never seem to go down. However, due to recent events, Disney's parks have been closed, bringing its share price down much more than its other blue chip peers. Adding on to the safety of Disney, they also recently introduced Disney Plus in November of 2019. And recently it's just been blowing up, securing 50 million users in the past few months. And now that Disney is being slightly bruised just a little bit, it might be a good opportunity to buy into a very stable company with a good amount of growth and a very, very wide moat at a significant discount. Just a very great business in general. So those are the 4 stocks on my list that are high return but also have relatively lower risk and are being undervalued at the moment. Other honorable mentions might also include Facebook, with their new free online meeting software that completely takes out Zoom, along with zero debt. But honestly guys, if you just invest into ETFs like VOO, VGT, or QQQ, you'll probably do just fine as well. These are just some of the companies you can look at to increase your returns if you want to take on great value, and you do have some risk tolerance. Some of these companies are less risky than others, so make sure you do your research and choose the best for you, as this is your money. The only way to really learn is to become independent from all those people on Wall Street telling you exactly what to buy and when to sell. I really hope this video helps you out on your investing journey. Make sure to leave a like and subscribe if this video gave you value and you want to see more videos just like this one. That's it for today guys. Thanks for watching, and we'll see you in the next video. Thanks guys for watching the video if you made it so far, and if it gave you value and you want to support my channel, remember to subscribe, drop a like, and really just interact with my channel. It really helps a lot. I've really had fun making these videos as of late, and especially when I know it can reach some of you out there and really make a difference. That's really my passion for making these videos. So for now, that is the video. If you want to check out my other videos, my channel is mainly about financing and current events, and if that sounds interesting to you in any way, you can go check it out, and I'll see you guys hopefully in the next video. Thanks for watching.